Before everyone comments there is more to underwriting than projecting exit cap rates and it varies by market, know that I already know that. And this video is regarding a general concept and a question posed to get your thoughts. So with that said, historically, the industry accepted standard for underwriting a projected exit cap rate is the market stabilized cap rate plus a 10 basis point increase for every year held. The reason for this is because there is a possibility for interest rates to expand and or market conditions to soften. For example, if you're buying a value add property at a 4 cap, but the market stabilized cap is a 5, and you're holding for 5 years, you would expand the cap rate to a 5.5 exit. I'm not saying that's how everyone does it, but that is a general industry accepted standard. This industry standard has been adopted over the past several years, and during that same tenure, cap rates have compressed mainly due to a decrease in interest rates. In other words, using that same example, when people have recently exited, they were able to exit at a 4.75 or actually lower in some cases. I've continually preached since 2018 that cap rate compression and interest rates is what landed the historic 20+ IRR returns, not operations, which is why so many people are in hot water right now with being forced to perform via strong operations. Today, we find ourselves in a much different situation. As interest rates continue to rise, cap rates continue to as well. The question is whether or not the interest rates will continue to rise, stabilize, or dare I say fall? I don't have a crystal ball, so I don't know the answer, but I would suspect at some point over the next 3 to 5 years with the interest rates will come down again. That period of time also just happens to be the industry standard hold period for a value add. So the question I have for all of you is, if you believe the same to be true, how do you underwrite the exit cap? I think we could all agree there are basically 3 possibilities. First is to stay the course, keep adding a 10 basis point increase for each year held based on stabilized market cap rate. Number 2 is to take a little risk, use the current market stabilized cap as an exit cap too. Or last but not least, throw caution to the wind and use a cap rate that is less than the current market cap. Out of all of those 3 possibilities, which one would you pick and why? Let me know what you think in the comments. And if you like this content and want to see more, make sure you like, subscribe, and share.